Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because I sent out an email telling you that it's up or it's in a blog post that I've written, and you're reading the blog post. You got an email about the blog post. But if you're not on my email list, you need to get on it. Look below the video, look in the description. You'll see a link to join because you need to get my free stock trading updates because we're seeing interesting things in the markets. And I'm going to talk about a controversial trading tactic, and it's one that I'm now employing, and that's short selling. Just the simple mention of short selling, I know, is going to anger many people that are new to the markets because they like to just think in one direction. That tends to be how the newbie in the markets thinks, that the only direction to think about is up. The markets also can trend sideways or trend down. And this is not a video to suggest that the stock market is going to crash, but I believe that the momentum that we saw last year in this tremendous up rally is diminishing and has done so over the past couple of weeks. We've seen that in a decline in the internals in the stock market. That means that there have been more stocks that have been fading than going up, even though the market average has been going higher. And that's not to suggest that you should sell or anything like that. I just want to talk about what I'm doing and show you what I'm doing in the market so you can understand. I've been trading the markets really since 1999 or late 98. And for 3 years, I co-managed a hedge fund. I've written the book, Strategic Stock Trading. I've got a lot of experience doing different things in the market. And I'm more long than I am short. But because of what I see in the market, and that is I believe that the upside momentum is fading, I've taken a shift where I'm starting to short some stocks. And that the original hedge funds were both long and short. They would take like a 50% long position and 50% short position. And the idea behind that was that they were going to make money from their ability to pick out stocks, that could beat the market and stocks that would fall or lag even if the market went up. And it was that ability that would pick out the stocks, their stock picking ability, that would enable them to generate good returns instead of simply being 100% long and hoping that the market would just go up and make money that way. And I'm not saying stop doing that. I've got more long than short positions, but I believe that the best way to be long in the market is to be long stocks in sectors that are beating the market. If you want to beat the market, that's how to do it. But shorting lagging stocks is a way to lower the risk in your account of any stock market drawdowns or declines, because stocks that lag the market tend to really dump really bad when there's a correction. And they can also fall anyway, even if the market goes up, when the internals of the market are fading. And those internals can fade for the rest of the year, and the market averages could continue to slowly trend up or even sideways and be okay. And in a sideways market, stocks and sectors that beat can still do good too. But that's my overall, thinking here. But a lot of people demonize short selling. A lot of people out there, will tell you that if your stock fell, it's because short sellers caused it to fall. And they're really covering up their own mistake in recommending these stocks or problems with these stocks that, are out there. It really is, it's in the long run, short sellers really have little impact on the stock market declines or individual stocks declining. In fact, short sellers lower volatility in the market. They don't cause crashes when they happen. They actually make the crashes less bigger than they would have been, because what short sellers do is they short stocks when they rally and cover to buy when they decline. So they help cushion the declines. I'm not trying to go into a big lesson of how to short stocks. You can look it up on Google and find out how. I just want to show you the stocks I'm short, and to give you an idea of why or how I choose them out. But one of the things I look at is the sector the stock is in. I want sectors lagging the market. And year to date, the worst performing sectors of the market have been airlines and hotels and fad stocks that were big winners of last year. Many of these stocks and sectors actually peaked out in February, and much of them make up and dominate the holdings of the ARKK ETF. So many of the stocks I'm short are actually in the ARKK ETF. That's why I'm titling this video, Why I'm Shorting Stocks in the ARKK ETF, because the ARKK ETF did well last year by loading up in fad stock plays, regardless of valuation, regardless of fundamentals. And the ARKK ETF peaked in February and is now badly lagging the stock market averages. Let me show you a chart of the ARKK ETF, and then we'll look at some of these stocks I'm in, or all of them. I'll show you all the shorts, all the stocks I'm short. But this is the ARKK ETF, and it fascinated so many people when it like went from 80 to 160 and doubled, and all these people piled in. It became a top owned stock on the Robinhood 100 list. 20 million Robinhood accounts are out there, and many of these millions of people piled into this because they saw it go up and they saw other people in Robinhood buy it. So they piled in, as a herd does, but then it peaked, and now those still in it are holding the bag on a horribly lagging position. And the ETF is lagging because the stocks inside of it, almost all of them, are now badly lagging the market. It's a complete disaster. And the indicator on the bottom of this chart is the relative strength ratio created by dividing the price of ARK by the S&P 500. It peaked in February and has been in a steady downtrend ever since. What that means is that this ETF is lagging the market. When the S&P 500 goes up, this ETF goes up less. And when the S&P 500 goes down, it tends to go down more. It's by holding and owning positions like that one is a loser in the market, because you end up losing a lot of money. And that's, why fad stocks can be bought. They can, when you got momentum to the upside as short-term trades, but they're awful and horrible long-term investments. So I'm going to show you one stock I'm short. I think I'll show you all of them, but it's in this ETF, and it's Peloton. And Peloton was a fad play a year ago. I often mentioned on CNBC as it ran up, but now it's a laggard. It's been lagging since January. But one of the reasons why it's a laggard stock and was always an awful investment is because the valuation in it is ridiculous. And in the long run, the price you pay when you buy a stock as an investment is one of the most important factors. That's why I like to buy stocks paying dividends that got fundamentals and a good price valuation. It's one reason why one of the sectors I'm heavily invested in is REITs. In the REIT ETF, RWR, I own in my IRA, and it's outperforming ARK. It's been outperforming ARK for months, perhaps for a year or longer. But this is something going up, 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 or at least outperforming the market, and the stocks in it pay dividends. Peloton pays no dividend at all. And the thing about the valuation of Peloton is the PE is 134. The forward PE is 153. Look, traditionally speaking, a PE of 15 is fairly valued. But even worse is the price to sales ratio of 10. A price to sales ratio is 1 is fairly valued. When I started investing and trading in the markets, books like One Up on Wall Street recommended looking for price to sales ratios of 0.5 to find cheap stocks and then look for earnings growth to get the perfect combination. This stock has the worst combination of valuation because it's wildly overvalued. And that's the real fundamental reason why the stock is such a millstone now for those that own it and a laggard. Again, I'm not trying to bet I'm not shorting some stocks with a portion of my account in order to bet on a stock market crash. I'm operating as a hedge fund who has both long and short positions. And in the end, I have more long positions than I do short positions. I'm just focusing in this video to show you, if you're interested in shorting stocks, what to look for. Look for stocks with high valuations that are lagging the market averages. And this is a combination that is making up the ARKK ETF. It's actually many of the Robinhood top 100 stocks have this same combination too. So an example is the Buzz ETF, which launched in March with the objective of buying and holding the stocks that are the most talked about on social media and the most owned by small investors. They tend to be fad stock plays, and the ETF, although it's not doing as bad as the ARKK ETF, is still a stock market laggard when it comes to the S&P 500, because you can see the relative strength index is in decline. Well, this ETF has got some of the same holdings as ARK. And when I looked for stocks to short, one of the things I was looking at was whether I was looking at the stocks of this ETF and in ARK, among another thing I looked at, which I'll explain. So I'm going to share with you another screen, and that is not my software, but the software that I use to analyze stocks, sectors in the market. This software is called TC2000. It's owned by Telechart. I pay for it, but you can get a free version of it if you go to the website freestockcharts.com. I don't make any money if you do that. It's just what I use. That's why I'm telling you about it. Now I'm going to use it to show you every single stock that I have a short position in by sharing the screen of that. So this is TC2000, and I'm going to go through all 42 stocks. And you can see on the bottom is a red line. That's the relative strength ratio. I know these charts are much harder to see. That's why I show you the other stock charts, but I'm just going to name them. Some people only listen, are watching, they listen, to what I'm saying. They sit and glued in front of the video. And I actually put this out on a podcast too, but I'm going to name them off. All of these stocks are lagging the market. American Airlines, symbol AAL, Amazon, ANET, Apps, Boeing, Booking Holdings, symbol BKNG, Boyd Gaming, CCL. And the casino sector is one lagging the market averages too. Coinbase, which I actually shorted when it popped up the other day, last week. Salesforce, CRM, Caesars, which is lagging the market. Delta Airlines, Disney, which gapped up on Friday and faded. It's stock in the Dow. EXAS, Exact Sciences, badly lagging the market. Expedia, Ford Motor Company, Grow Generation. Okay, let me point out something with this stock, because I ran another scan to find some short candidates. This stock popped up, and the scan was a very simple one. Look for stocks that went up the most since October to last February. And I looked through them all, looking for stocks that then lagged the market and appeared to be in a position where they could roll over and they had high valuations. Fad stock plays, in other words, that may not be in the ARKK ETF is what I was looking for. And I took a short position, and I think it was about a dozen of them. This was one of them. IWM. I can't short individual stocks in my IRA, so I'm using an ETF that shorts the Russell 2000 because the Russell 2000 is lagging the S&P 500. I'm not really excited about short ETFs, but it's just something I did in there. CarMax, Love Airlines, Las Vegas Sands, Marriott, Mountain Vale Resorts, another casino, Netflix, NSTG Technologies. That's a stock that's came up on my scan as a fat laggard. PagerDuty, which is in ARK, by the way. Penn Gaming, I think it's in ARK. I know it's in Buzz. Penn Interest is in ARK. Party City Holdings, a laggard. Peloton, there it is. PayPal, lagging. SPY ETF. PayPal's, I'm not short SPY, I just have it on here to look at. Teladoc, T-Mobile, Twitter, United Airlines, Upwork. That was one of the stocks like Peloton, which was so popular to buy last year that it was touted almost every single day, all on CNBC, now a laggard. Marriott, Workday, Wynn Resorts, Zillow Group, Zoom Communications, American Airlines back again. And so here's the deal. I'm not really doing this video to recommend that you short stocks. Shorting stocks is not for everybody. But, something I do think, look, the number one way to make money in the markets is not actually shorting stocks but to buy dips. That's the number one way to make money in the markets, and whether it's investing or trading, that's the number one way. Buying dips when the stock market corrects in sectors that are poised to become the next leadership group after the dip is over. We saw a massive dip, obviously, last year in March, led to a great buy opportunity. There was a smaller dip last year when the NASDAQ pulled back about 10% after Labor Day. The S&P also had a pullback. That was a good buying opportunity. In some sectors, took time to come out of the March crash of last year to then rally. Energy stocks is one of them. The REITs also. But we're not in that environment now. We're in an environment where the market has rallied for months on end. It's not really a great time to make lots of new buys in the market. And if you want to do the strategy of buying on a dip, that means you have to have some cash reserves and be patient enough to wait for that dip to come, whether that comes or starts in weeks or months or even next year. That's just the way it is. It's not exciting to people. People want instant trades, and everyone out there on YouTube caters to that. I'm not doing that. This video is likely to get a lot of dislikes because I just mentioned short selling. It's a taboo topic. It's one that actually generates anger. It's not honestly, it's not one I'm going to do many videos about or talk much about. I just want to tell you what I'm doing. That's all. But again, short selling is not for everybody, and I could get out of these short positions any day. If they turn against me, you got to be flexible to short stocks, and it's difficult because to get a good entry point, you have to do it, into rallies or when it looks like rallies are over in the stocks. You can't short on big declines because it's too late then. Whereas when you go long the stock, if you buy into a rally and then it dips, so you have a small loss on them, often enough, if you just wait, it'll come back. And normally it does until you get to a situation like now where the internals start to falter. Then most stocks aren't going to do that. The averages can do that. The best sectors can do that. But stocks like Peloton, if Peloton ends up being up today and you buy that, and then it goes down, the next day, whereas a year ago, you could easily see it up a week later. Not the case now. So we're in a different trading environment for a lot of stocks that are now lagging the market. Stocks below their 200-day moving averages are now tough trades to go long on. And so we're in a different environment than we were just 2 months ago, much less last year. And I'm adapting to that by now taking some short positions and frankly, doing less trading. I'm not planning on doing many trades, much less much buying in the market, until there is some sort of pullback. So I'm actually going to step away from watching the market as much as I may have been in the past. So all that said, good talking with you. And if you're just watching this for the first time on YouTube, click the subscribe button and then click that bell. And then YouTube will send you the next, it'll send you an alert the next time I put a video up. And also hit that like button, because I know this video is going to get dislikes. So that your like button will help balance that out for me. And I certainly do appreciate that. So all that said, I'll be talking with you later.